Good morning and welcome to today's business structuring webinar. Today, we're going to go through some of the basics of business structuring and the things that you do need to know to structure your business for success. Before we go through that, I'm just going to introduce myself briefly. My name's Shaun Farrugia. I'm a CPA who's had the pleasure of working with small business owners for almost the last 18 years. 7 years ago, I started a business called Optimised Accounting, and we specialise in working with ambitious business owners in the western suburbs of Melbourne. The businesses we work with range from small trade businesses and consultants turning over a couple of $100,000 a year, all the way up to larger businesses that have turnovers in the range of $45 to $50 million. What we discuss today in the way of structuring is going to cover aspects and different sort of entity types that are relevant for both of these turnover ranges, the implementation, and I guess the sophistication and complexity of it will differ depending on size. So on that note, anything that we do discuss today should be seen as providing general information only. We recommend that you do seek your own advice that's tailored to your exact situation before implementing anything that we discuss. So that could be from your accountant or your lawyer, or if you're joining as a client of Optimised Accounting today, then obviously we're in the best position to be able to assist you with this. So what we're going to cover is, first of all, is what is structuring and what do you need to consider when structuring a business? The common types of business structures and some of the considerations for each. And we've also been lucky that a couple of the people who have registered to view today have asked us a couple of questions. So we're going to go through those briefly at the end. So first, we're going to start with what is structuring and what to consider. The legal and tax, what structuring is the legal and tax framework that surrounds your business. So depending on the type of structure that you do choose, there are various legal and tax requirements that do need to be looked at. So for example, the first few structures we'll talk about are fairly simple and there's not really a lot of complexity there. And then when we get into companies and trusts, there's a few more government bodies that you do need to keep happy. The one common thread that of a government body you do need to keep happy regardless of your structure is the ATO, but we'll go into that in each of the structures shortly. So apart from legal and tax framework, what you do need to consider as well is your family situation. So this could be, are you single? Do you have a partner? Do you have adult kids or potentially younger kids? Are you a mixed or a blended family? Do you have older parents that you might be able to use for tax purposes if possible? All of these things do need to be looked at when sort of putting the structure and everything together, as well as risk and personal assets. So if we're setting up a business and we've got one partner that might have, be taking the risk within the business, we want to make sure that any assets they hold, so things like the family home or investments or anything like that, are safe from creditors as much as can be. The other things that we do need to consider is the industry norms or requirements. So things like some industries won't really allow people to incorporate. So for example, there may not be much benefit in certain occupations such as medicos to set up companies and trusts for their own sort of consulting income. But then on the flip side, you might be working with large retail like supermarkets, or you might be working in construction or potentially with other large corporates where it's almost mandated that you are a company. So those industry norms and everything do need to be looked at as well. And then in other terms is the level of income that's likely to be earned. So if the business is likely to be just a side hustle that you're doing on top of your normal job, then the structuring there will be very different to setting up, a business that you're intending to expand over the next 5 years and maybe have multiple locations. And then one of the last other things to consider is how you intend to exit your business in the future. If you're planning on selling it or handing it down to family members or anything like that, how you structure it will depend on how much tax you pay at the very end. So the first structure we're going to discuss today is sole traders. So sole traders is almost the default option. So when we talk about sole traders, this is you running your own business. So for example, Shaun Farrugia operating, let's say a retail outlet, Shaun's Plumbing Supplies. I can register an ABN online. I can register a business name through ASIC, and it'll be Shaun Farrugia trading as Shaun's Plumbing Supplies. That can be done probably in about 20 or 30 minutes, assuming that the ATO website is working correctly, which can be a problem. But assuming that that is all running okay, you can really get this going really easily, really cheaply as well. There is not really much complexity to running as a sole trader. So it's really looking at a sole trader, especially with a business name. The business name's more so like putting a mask over your face, and that's your new identity, is the business name that you trade as, or maybe just wearing a name badge. So any profits that you do earn do get taxed to you personally. So this means that when you're lodging your own personal income tax return, at the end of every financial year, it's a couple of additional pages that gets added onto that document. The good thing about the tax, though, is depending on your income, is you can either pay 0% in tax if you've got no other income. So assuming you've got no other jobs or employment or no other investments. So you could pay no tax if you weren't making a huge amount of money. But if you were if the business was going to take off and you were earning some sort of substantial profits, the tax rates do actually max out at 47%. So for this reason, any business that's likely to be run in the future as a sole source of income, you do need to be really mindful that the tax can be quite high. The other thing to consider with sole traders and from a tax perspective is there isn't really any tax flexibility. So it means that if business does blow up and you do have some large profits, you can't distribute the profits to other family members or other entities to save tax and to optimize your tax situation. So it's fairly rigid in that sense. The low complexity does come with the trade-off of, it is a simple structure and doesn't give you some of the benefits that other structures may afford. The other thing to keep in mind is that you are the business. As we said, you're wearing a mask or just wearing a name tag. So there isn't really any asset protection here. So if you're running a business and you get sued by one of your creditors or potentially a customer, then your personal assets like your home or any investments that you may have would be at risk. So this is also a downside of running as a sole trader. As we mentioned as well, there's not really a lot of flexibility for tax, but there's also not really much flexibility of bringing on new partners. So if you wanted to maybe promote someone, or you had an employee wanting to buy in, or potentially you were going to merge with another business, you couldn't do that as a sole trader. You would need to restructure. So when we do look at this, sole traders really are suited for very small businesses or side hustles, or for very low risk businesses. Any business that is going to be a sole source of income and it's going to earn a reasonable amount of money, we would really want to look at not really setting someone up as a sole trader as a general rule of thumb. Obviously, this will differ depending on the situation. So moving on from sole traders, we go into partnerships. So when we say a partnership, what that really is two people, so two individuals, or even think of it as two sole traders or more. You can have multiple partners running their businesses together. So where I have Shaun's Plumbing Supplies rather, and if I wanted to bring on a partner, let's call him Steve, then Steve can come in business, and we can set up S&S's plumbing supplies. So in that sense, it'd be Shaun and Steve working together, running their businesses. When we do look at the two people working together, there is a low documentation requirement. So in this structure, compared to having multiple people working together in the next structures we go through. So when we say there's low documentation, the requirement is actually zero documentation. It just is an ABN registered with the ATO and then a business name if that's what you're wanting. But I say low documentation because anyone that sets up a partnership without really having a partnership agreement is frankly nuts, in my opinion. So when we say a partnership agreement, this is a document that's written up by your solicitor, and it's pretty much like a prenup, or it's the rules and the guidelines of what the partners agree to on how they're going to run the business, how decisions are going to be made, and how disputes are going to be settled. Like a prenup, it's always good to get these documented early on when everyone's happy, rather than at the end when there's a feud. So I'll stick with low documentation requirements, but then we move on. It's low complexity. As we said, it's just another ABN that's registered. You can get this up and running fairly quickly. Profits are taxed to partners personally. So a partnership, if it makes a couple of $100,000 a year, won't pay tax in its own name. Now, when we say it doesn't pay tax, we're not talking about paying GST or PAYG withholding for their staff or anything like that. That's basically the business playing tax collector for the ATO and collecting money aside. What we mean is income tax on profits that are left over. So any of the profits do then get split by to the partners. The profit split is if it's two partners, it'll generally be 50-50, but a partnership agreement may stipulate that there's a different split of profits depending on the circumstances. So while there is the ability to split profits, which is better than a sole trader, it is still rigid and it can't be changed sort of year to year. And if the partners do have large other sort of income, they might be working another job or have other investments, then the tax is still going to be between that 0% threshold or 47%. So it can still tax you quite a bit. And the other problem with partnerships is if, Shaun and Steve's plumbing supplies wanted to open up a second location and we needed to, maybe keep some extra money in the business to reinvest and to, buy more stock for a new location or something like that, then the money or the profit that was made in the business does need to be taxed to the individuals first, and then it gets reinvested back into the business. So, if the business was going well and, the tax rate was 47%, if the partner was getting 100 grand, you might only have 53,000 left over to reinvest in the business. This does put quite a bit of a drag on reinvestment in business and, actually helping the growing. But when we look at the biggest problem that we see with partnerships, or the biggest problem that I think that we've got, is that there's unlimited liability. So what this means here is that not only are you responsible and you can be sued personally just as you could as a sole trader, you're also responsible for your partner's mistakes. So for example, in Shaun and Steve's plumbing supplies, say I sign a contract that causes us to be sued, and we're getting sued for $100,000. They may look and say, oh, wait, Shaun's got no assets. He doesn't own anything, so I'm not going to go after him. They can go after Steve for that amount of money. Now, Steve may not have even been aware of the decision. So for that reason, we don't really like the idea of unlimited liability, as it just sounds, it's just horrible, just the words. So for that reason there, we really don't like looking at partnerships. You can, if you are wanting to bring on new partners in the future, you do need to resettle a partnership, which means, getting a new ABN and new bank accounts and insurance policies and all that kind of stuff as well. So it does become complex to add and subtract new partners. So pretty much for all of those reasons, low tax flexibility and potentially high tax rates for successful partnerships, the unlimited liability and the difficulty in bringing on new partners, I would say partnerships are one of those things that we steer away from. It's very, very rare that we would suggest a partnership to anyone. And this is something, look, I am happy to sort of debate with people. I know there's differing opinions on it, but the only time I'd ever really suggest a partnership would be, husband and wife, because in that situation, assets are probably intermingled anyway. And look, even if they're not on title, for family law purposes, they are. So you're not really adding a lot more risk, but you still lose that tax flexibility of being able to, maybe distribute much more to one partner 1 year or less, another year to, really optimize that tax situation for the family. So really, it's only going to be suited for passive investment properties and things like that. So yeah, with partnerships, as you can probably see, I'm pretty negative on them. And that's just because for two people working together, the next two structures that we discuss do have a lot more benefits, and I would say are more suitable in most cases. Okay, so now we're starting to talk about companies. Before we do talk about companies, I do want to clear up a couple of things. So with companies, there's something that sort of happens when people are describing what a company is and what a business is. And I just want to clear this up because businesses and companies are not interchangeable words. So companies can run businesses, but not every business is a company. So sometimes you'll have someone, it'll be, Shaun Farrugia sets up Shaun's Plumbing Supplies, and I might go around telling my friends, yep, I've got this company, it's called Shaun's Plumbing Supplies. No, I don't. I'm a sole trader. I've got a business that's Shaun's Plumbing Supplies. This might sound like, accountant going off on a rant for, technical detail, but it is important when we say a company that you do understand we're talking about a proprietary limited company. So that's, if I registered Shaun's Plumbing Supplies Proprietary Limited, then that is a company. And the reason why we do need to be particular about it is the complexities and the risks and, the tax implications are a bit more stringent for companies. So we do need to make sure we know what we're talking about. As I just sort of mentioned there as well, it's a company is a separate legal entity. So just like, I've got my birth certificate, my son's got his birth certificate. When I register a company, I get a certificate from ASIC, and that is in effect the birth certificate of a company. Now, when we say it's its own legal entity, what that means is it can enter contracts on its own. So we can sign a lease agreement or a supplier agreement in the name of a company. It can sue or take legal action against somebody, or it can have legal action taken against it. So for those reasons, it's got separation from the people that are behind it and running it. And the other part, the other part of it being a separate legal entity is it is also separate from the individual in a way that it will survive upon the death or, the disability of the actual people that are standing behind it. So companies can be bought, they can be sold, you can bring other partners in and things like that. So onto the roles that are there in companies. So companies will have roles of directors and shareholders. So when we say a director is the person that has the obligation to run the company for the benefit of the shareholders. That's a very sort of formal term, but what it means is if I'm setting up Shaun's Plumbing Supplies, I'm most likely, as Shaun, going to be the director, which means I'm the person controlling the company. Now, that means day to day, it's me signing the documents and everything because, well, it's a separate legal entity. It doesn't have a heartbeat, a brain or anything like that. It relies on the directors to make the best decisions possible. So the director is the person who controls the structure. And that is, as we said, is for the benefit of the shareholders. Now, the shareholders is just a fancy name for owners. So if I've got Shaun's Plumbing Supplies and there's 100 shares that are issued throughout the business, then if I own 100 of those shares, then I'm the 100% shareholder because I have all of the shares. Now, there's no limit on the amount of shares that you can have. So as a shareholder, I've got the benefit of being able to receive a dividend. That's the share of profit from the company. And that's how my ownership is determined. So if, for example, I sold half of my shares across to Steve in Steve's S&S Plumbing Supplies, then I'd be entitled to 50% of the profit, and then Steve would be entitled to the other 50% of the profit. So with shareholders, they've got the benefit of being able to receive dividends, and they also then have the power to vote in directors. So this means that if I've got the majority shareholding, I can vote in or remove a director as I see fit. In most smaller businesses, the shareholders and directors are one and the same, or they're closely knit anyway in family or corporate groups. So this isn't as big of an issue as it is in large companies and ASX listed companies. So we've sort of explained the roles here. As you can see, there are some more complex requirements for companies, and that's just by the nature of its own separate entity and has these other roles. So when we say there are more complex requirements, what we sort of mean by this is you do need to keep ASIC happy as well. So ASIC is the regulatory body for companies, and it handles all of the registrations. So there's guidelines there. The company will also have to lodge its own separate tax return and prepare formal financial statements. That's a requirement that the director has to make sure that they abide by. And there's also the requirement every year for the directors to state that the company is running solvent. And what we mean by that is that the company can pay all of its debts as and when they fall due. So all of these requirements are there is to make sure that, companies aren't running up huge bills and then running away because there's limited liability. So where we've talked about partnerships and sole traders, and there's unlimited liability where there's a lot of risk there for personal assets from the person who's running the business. There is a lower risk to personal assets when you do run as a company. So as we said before, the separate legal entity can take action, can trade, can do all that kind of stuff. That gives an element of separation between the people who are running the business, so the directors, and the public. So personal assets are generally a bit safer if you are trading as a company. Now, this isn't a completely impenetrable force field. If you do break the law, so, there's OHS regulations that you've gone, Shaun's Plumbing Supplies hasn't provided the right safety gear to its employees and someone falls and breaks their neck, then as a director, I could be personally liable. Also, there's times where directors may consent to giving some personal liability. So for example, signing up a lease agreement for a new shop, I might need to sign a personal guarantee. In that case, what I'm saying is to the landlord is I'm going to pay the rent if my company can't. In that case, you voluntarily agreed to take on some extra liability for the company. So when we do talk, there is a element of separation for general sort of trading and things like defects and everything, but you still need to abide by the law, of course, otherwise you can be found, liable. And from a trading, there are the times where you might give away some of the liability for, signing on leases or, bringing on supplier accounts and things like that. So there seems to be, a bit of benefit there in the liability side, but there's also a bit of complexity that we've just sort of gone through. So why would we do and take on this complexity? Well, the limited liability, of course, but there's also a capped tax rate of 25% for trading companies. So where we were saying before, if there was $100,000, S&S Plumbing has available to expand into a new location, in the partnership structure or as a sole trader, the tax rate on that 100,000 could have been 47%, and I'd only have 53 grand left over. And then when we talk about running this through a company, those additional profits could be only taxed at 25%, and then you've got 75% left over. So there's much more benefit. It's much more beneficial. Not only are you paying a lower tax rate sort of day to day on funds that you do keep in the company, those funds can then be reinvested and grow the business, and you can grow the business a lot quicker because you've got access to this cash without having to give more and more money away to the ATO. So that additional 22% that you would give to the ATO between 25 and 47, is a huge drag on being able to expand the business in a sole trader or in a partnership sort of structure. So cap tax rate is brilliant for businesses that want to grow or want to be able to control how they're paying out their profits. When we do talk about paying out profits, this is paid out, as we said earlier, to the shareholders, and this is done by way of dividends. So let's say that we're really happy with our growth strategy at the moment, and at the end of the year, the directors declare that there's a $100,000 dividend that can be paid out. So not only would that get split to the shareholders in proportion of their ownership, they would also get a share of the tax credits that have been paid by the company. So if, for example, there was, let's say there was $100,000 of profit at the end, we pay $25,000 in tax, and there's $75,000 that's left in the bank account to pay out. Not only can the dividend be that $75,000 that goes to the shareholders, but that 25,000 that went to the ATO can be broken up proportionally as well and given as a credit to the shareholders. So when a shareholder does their personal tax return, they'll include not only the 75,000 or their share of it, of the profit, but also their share of the tax credit. What this means is that even though the company pays tax and then the individual pays tax, this makes sure that there's no double taxation happening. So this keeps the tax at the right levels. If funds are kept in the business, then the tax is only that 25%. Once the funds leave the business for personal use, then personal tax rates apply, but you're not being penalised by the money that the company's already paid as you get a credit for it. It is easy to bring on new shareholders in a company, so you can buy and sell shares between the existing shareholders. So if I owned Shaun's Plumbing Proprietary Limited and wanted to bring Steve on board, I could sell him 50 of my shares and become 50-50 owners. But the other thing I could look at doing is issuing additional shares. So if I wanted to issue shares, the company, rather than me as Shaun selling my own personal shares, we could issue additional shares within the company. And that means that the company would then get the money from Steve for the buy-in, and it would have that additional capital for expansion. So this is really handy if you're wanting to raise capital to grow a business, and can also be tax effective in certain situations as well. The last thing I wanted to discuss just on companies is it is a preferred structure for banks and governments. Banks understand it because it is regulated by ASIC. They can do independent corporate searches and see who the directors and shareholders are of a company at any stage. This means that it's really easy for them to find out what's happening. And because the rules of the company are governed by the Corporations Act, they have got a lot of confidence in being able to lend and work with companies because they know what they're working with. And when we say with government, there are certain stimuluses like R&D offsets and grants, as well as other grants as well, that are only available to company structures. So if you're running a business or intending to set up a business that is eligible for those, it is important to make sure that you do consider what help you might be able to get from the government and make sure that you are eligible for it. Okay, so we're going to move on to trusts now, and I've broken this up into two different sort of categories, only because a trust is where things can get complicated, but what we find is usually the complexity of the trust is more than outweighed by the benefits that a trust can give you. So we're going to touch on briefly is the types of trusts. So the two trusts we'll talk about today are unit trusts, and we're only going to touch on that briefly, and I'll explain why in a moment, and then also discretionary trusts. So discretionary trusts are also known as family trusts. When we say trusts, the way of thinking of what a trust actually is a trust is a relationship between two parties. So a trustee and a beneficiary. So a trustee and a beneficiary is similar to a director and a shareholder in a company situation, but a trustee has the obligation to manage the assets in the business for the benefit of the beneficiaries. And the beneficiaries are like the shareholders, the people who are entitled to the money. So when we look at this, how it's actually governed is not by a corporate certificate or by ASIC. It's actually by what's called a trust deed, which is a legal document that you draft up. You don't draft up yourself, obviously, but you have a trust deed drafted up, and that governs how a trust actually works. So there's a lot more flexibility in trusts because you can change that deed with the help of a lawyer to suit anything that you want. You're wanting to sort of say. There are rules and things that do need to be considered with the deed. It's not a free for all just because it's agreed in a contract, but there is a lot more flexibility in this compared to some of the other structures. The other thing with trusts is the way to think about it is everyone that's probably listening to this is involved in a trust in some way, shape, or form. The other trusts that we aren't going to discuss today, but everyone's part of, is a super fund. So not only a self-managed super fund that is in effect a trust, but also your large industry super funds or retail super funds. So if you were with MLC or you've got a CBUS account, those are in effect trusts. So the people working at those funds, they are the trustees, and they've got the obligation to make your super grow and to act in your best interests. Okay, so we've talked about the how a trust is and how it's governed. And so the roles of the trust, as we've mentioned, there's the trustee, the person who controls. The beneficiary is the person or the people who have got the benefit of the trust's assets. Tax in trusts. So with the two trusts we're talking about today, unit trusts and family trusts, we like to think of these as funnels. So if you look at the top of the funnel, you've got all your trading activity and your revenue. The funnel is where the magic happens and the business does what the business does. At the end, with a bit of luck, there's profit, and that profit goes out of the funnel and goes across to the beneficiaries. The funnel analogy will be used a little bit later to explain the differences with unit trusts and family trusts as well. So for this, a trust doesn't actually pay its own tax. So similar to what we said with the partnership before, it just streams out. So it's a flow-through vehicle. So it's worth noting with trusts as well, for businesses that are wanting to expand or that may be capital intensive and needing to reinvest in stock and everything, trust may not be the perfect structure, because depending on how it's set up, the tax that you're paying may be higher than the 25% corporate rate, which gives that little bit of extra drag on being able to reinvest the money in the business. Asset protection in a trust can be good. So there's a couple of options that you've got on asset protection. So when we were saying that the trustee is the controller before, there's two types of trustees that you can have. There's what's called an individual trustee, and there's what's called a corporate trustee. Now, the easiest way of thinking of this is an individual trustee is like your sole trader. So the risks that you had as a sole trader before, the unlimited liability and things like that, that is what would be that is what would come from having an individual trustee. A corporate trustee is having a proprietary limited company acting as trustee for the trust. So you then get the asset protection elements that a company has. So this is almost a mix and match where you can have keep it simple and a little bit more cost effective by not having a company as trustee and having an individual, but you've got some of those pitfalls. But with the company, then you've got those benefits and the asset protection benefits that a company has. It is worth noting when we say the asset protection benefits there, we are talking about legal risk if the business was to be sued. We're not talking about the tax side of it. So trusts are more flexible with tax. It's just the asset protection elements it borrows from the sole trader or the company side of things. Bringing on partners, we'll touch on that in a moment with unit trusts. It is easy in unit trusts to do that, but not so much in family trusts. So we'll elaborate in a moment. And then the last point on just the general parts of trusts is banks and government can be confused by trusts. As you can sort of see, they are fairly complex. We've gone through quite a bit of stuff on this slide of just the basics of trusts and how they work. Because of that, and mainly because deeds can be written and they're not all stock standard like companies are, or the regulation on companies are. Banks do want to review trust deeds a bit more often, so getting loans and things like that from banks can be a little bit more complicated than it is with other structures. And when we say government, I wouldn't have thought government would have been confused by trusts, but through COVID-19, especially with state governments, a lot of the stimulus measures did take quite a lot longer with trusts. And I think mainly because there's no central register of all the details of a trust, which meant that state government couldn't just do a good do an ASIC search and find out how the trust was run. There was a few more integrity checks they needed to do. I guess the good news here, depending on which way you look at it, is that federal government doesn't seem to share a huge amount of information on the ABR data with state governments. So when we talk about unit trusts, we're not going to spend a huge amount of time on this, but a unit trust can be looked at as being similar to a company. Now, when I'm saying similar, we're not talking about the legal protection or the tax elements. The legal protection will depend on who the trustee is. So if you've got a company acting as a trustee, you've got the same level of asset protection that you do have with a company. But what we're saying when we say unit holders, or what is a unit trust, it is held, and the interests in a unit trust are governed by the units held. So like a company has 100 shares, might have 100% of ownership. A unit trust could have 100 units, and each of those would represent 1% of ownership. The only difference here is the unit trust won't pay any tax because, as we said before, unit trusts are like a funnel, and the hose for the funnel will go giving 1% across to each of the unit holders. So unit holders will pay tax in their own names at their own tax rates, but yeah, it is a fixed proportion that they get, and that's based on how many units they receive. So there's not a massive amount of tax flexibility in a unit trust. They can be coupled with other structures which can give flexibility, but on its own, a unit trust is the profits are still determined by who holds the units, and because it flows through, the unit holder will have to pay tax in their own name on all of the profits. And if they've got other properties or other income, that tax rate could be between that 0% or 47% if the beneficiary or the unit holder is an individual. On the topic of who can be a unit holder, as I've just sort of said, a unit holder can be an individual, but it can also be a company. So if you're distributing profits to a company as a unit holder, then the tax on that company is 30%. So that means that the company then holds those funds, and you can limit the levels of tax there. So pretty much anyone can be a unit holder. It can be a company, it can be joint individuals, it can be single individuals, it can be a super fund. They can all be unit trusts. When I say super fund, depending on super fund rules, of course. Bringing on partners, it's easier in unit trusts, just as you can with shares. You can, the unit holders amongst themselves can trade units, so buy and sell from each other. Obviously, the trust deed will have some stipulations on that, but the trust itself can then also issue additional units, and that could be to raise capital. So it is easier to bring on the partners, but it is worth noting with a unit trust, because it is a flow-through vehicle for fast-growing businesses through the single structure, the profit does get taxed on the beneficiary, so the unit holder. So the tax rate there may be higher than, say, a company with 25%, because it's going to be subject to potentially individual tax rates. Then we move on to family trusts. So a discretionary trust and a family trust are basically one and the same thing. What we mean by a discretionary trust is the trust deed will have, first of all, it'll state all the parties in the trust, so who the trustee is, either the individual or the corporate, and who the beneficiaries are. Now, the beneficiaries in a family trust are generally going to be a family group. So for example, if my plumbing business has myself, I might have myself listed as the beneficiary. But because of that, the way that the deeds are written, there'll be the allowance there for me to make a distribution across to my spouse, my child, my siblings, my parents, any companies that we may control, a charity that we may wish to support, and a trust does last for 80 years. So the nature of the general beneficiary clause, which is who can receive money from the trust, generally will also cover my son. So my son, as we said before, is an eligible beneficiary. He's also only 5 years old, but it will cover his future spouse in the future if we wanted to distribute to his spouse, or potentially their kids down the track, so my grandkids. Obviously, this is quite a fair way down the track, but the deeds, because they do last for 80 years, are nice and broad. Now, this is either a great thing, depending on how you look at it, or can be absolutely scary. The beautiful thing about a discretionary trust is the word discretion, which means every year you have the discretion as to who can receive the profits on the trust. So what that means is 1 year there might be we might have the profit, and I might split it, 50% to myself, 50% to my wife, so we can save on some tax. The next year, my wife might have an investment, or she might, do some extra shifts at work, and her income might be higher than it otherwise is. So we might only give her, a small amount of trust profits in that year, and then give the rest to myself. You can chop and change every year. So with companies and unit trusts, there's that fixed ownership based on units. Discretionary trusts not only give you the discretion to distribute to multiple people in your family, but also the discretion to chop and change who you make a distribution to every financial year. So with that, it's worth noting 1 year it might be worth giving a parent or a sibling some money if that's the course of the way your family operates. They would then get taxed on that money on their own way. But then the next year you might say, okay, we're not giving anything across to them, and choose different beneficiaries. So you can sort of move the hose of the funnel to fill up whichever cup is the most suitable from your family dynamic and from a tax perspective. So there's quite a lot of flexibility here. Bringing on new partners is incredibly difficult, and that's because the benefit of the trust is for a family group. So as soon as you bring in additional partners or restructure, there is the potential for capital gains tax. But if you're going to hand the business down to someone in your family, so to my son, he wants to have plumbing supply business in a few years' time, then potentially he could then act as the trustee and run the business, and there'd be no capital gains consideration. So there's a few things there that do need to be considered, but they're not sort of perfect for everyone. There are a couple of additional roles in a family trust that you might see, and that's the role of an appointor and a settlor. So a settlor we'll go to first is pretty much the person who sets the trust up for you. So a trust has to be set up by having a capital injection. This might be $10 for argument's sake. But a settlor can never have any benefit within a trust. That's one of the rules that a trustee will say. So because of that, it's basically a set and forget. The settlor can be a friend, it can be the accountant, generally is the accountant or the lawyer, and that's the person who sets it up, because as long as you're not related to that person, then they're not eligible to receive money from the trust anyway. The appointor, though, is an important role. So an appointor is almost a god position in a trust. It doesn't have any day-to-day responsibility, and it doesn't have any day-to-day risk. But what it does have is ultimate control of of being able to replace who the beneficiary is, who the trustee is. So we were saying with companies before that the shareholders can vote out or vote in new directors. In a family trust, the appointor sits silently in the background, but can then remove a trustee if it sees fit. So, for example, if I had a corporate trustee, so Shaun's Plumbing Proprietary Limited as trustee for my trust, and that was going to be sued or had to be wound up for whatever reason, we could put in another company to act as trustee, or the appointor could step in or do whatever it wants. So it is an important role to consider there, and it's also important to consider having multiple appointors just in case, but something that needs to be discussed. The other thing on tax on family trusts are profits, as we said, stream out with trusts. So in this case, whoever you choose to be the beneficiaries each 30 June, they're the people who will be taxed, and they'll be taxed on the profits at their own tax rates. But the discretionary nature means that you can do it in a tax effective manner. So that's probably the end of all of our content today. But as I said, we did have a couple of questions that came in from people who were wanting to, that just had some questions to answer. So the first question that we've received is, when is it a best time to look at your business structure? Look, by far the easiest is when you're setting up a business. So when you restructure, there's always the risk of capital gains tax, but there's also needs to set up new trading accounts with suppliers, redo legal contracts and bank accounts, and get new ABNs and all that kind of jazz. So it's always better to look at your business structure right at the start, because it does save a lot of headaches and potentially greater costs down the track. Saying that, sometimes businesses will outgrow their business structure. So I would say it's worth looking at your structure and speaking to an accountant about your business structure, every year or two, or a good accountant will probably approach you if they feel that it is necessary. But it's always worth, opening up the dialogue if you think there are ways that it can be done better. What you would have to look at, though, is if you are restructuring an existing business, is not only the benefits that may be clear that you can receive, but you just have to weigh up the pitfalls and whether or not it's worth, the complexity and potentially additional tax in the short term for it. So yeah, look, if your business is running, I'd say, it's always good to reach out to the accountant. And when I do say that, it's not always about tax. It's you might be wanting to look at things like succession or growth, and that would need to be considered in the structure as well. Now, the next one is, I'm starting a building business and my accountant wants me to be a sole trader until I make 120,000 in profit. Should a builder ever operate as a sole trader rather than a company? This is a difficult one because it'll go on opinion. In my opinion, no, I don't think a builder should ever run as a sole trader. But I'm not saying here that your accountant is wrong. So your accountant's, the 120,000 is a magic number of when you move into the 34% tax bracket, into the 39% tax bracket. So what your accountant is looking at is saying that, you're not going to really recover the extra costs of having a company until you make that much in profit, and your accountant would be correct. But when you are running a building business, and when we look at structuring, as you've probably heard from the last 40 or so minutes, structuring is not just based around tax. It's also about legal risk and also future growth. So with builders, first of all, there is legal risk. If there's a problem, then your personal assets are at risk. So running under a company, sooner the better, is always a good thing. The aim is, I'm assuming, that you'll be making a lot more than 120,000 in profit in the short to medium term. So you do want to future-proof your business by having that structure. But the other thing to really consider is, the complexity of restructuring down the track. Things like warranty insurance and everything like that, you need to get out new policies and things, and it does become a little bit of a nightmare. So look, unless you were doing some very, very low risk jobs and it was unlikely you were ever going to hit that 120 in profit, then, in that case, I'd say, look, sole trader may be beneficial. Otherwise, yeah, if you were looking at growing it into a proper business and, having staff and bigger contracts and things like that, I would look at moving either to a company or at least talking about structure, early on, just to make sure that you're set up the right way and you don't have to kind of think about it again. So saying that, I'm not saying your accountant is necessarily wrong. I just think they might be looking at it through a tax lens only. Last question is, I've been recommended a structure that contains multiple trusts and companies. Why would this be the case? Look, I'd love to say lawyers and accountants do love to complicate things, but we do this for a reason in most cases. I know sometimes it can sort of seem overkill with structuring, but just to give you a bit of an example, let's say that we've got, Shaun's plumbing company again, but I'm running as a proper full, it's a proprietary limited company. So if I've got that company there, I've set up as a company because I want, my 25% tax rate for expansion. I want to be able to do, I want the limited liability aspects, all those kind of things. I want to be able to bring Steve on as a partner, all of that. Now, as a shareholder, I don't really want to hold those shares by myself, because if I make, all the money that I'm hoping to make in my plumbing supply business, then I'm going to get taxed on it personally, as the shareholder is, fairly rigid, the percentages and all of that. So my shares might be held by a family trust. That gives me some flexibility to, distribute to my wife, my kid, potentially, other family members down the track, as it may be relevant. So now I've got a company, but it's held by a family trust. Now, my second shop, I got a really good offer from the landlord. He wants to sell me the building. So I don't want to necessarily hold that building in my company, because if I hold my building in my company and the company gets sued, I'm going to lose the factory, because that's an asset. What I would and the other thing is, if I sell the factory within the company, then I actually don't get the CGT, so the capital gain general discount. So what I'll do instead is I'll have a unit trust potentially. My unit trust might hold the my property. That property will then do a lease or rent to my trading business. So if I ever get sued in the company, my asset is safe, because I'm only a tenant of the landlord, which is my unit trust. But not only that, when I eventually sell the factory down the track, I'd also be eligible for capital gain, the general capital gain discount as well. So as you can sort of see, it does get a bit complex. We've got clients that have got, up to, I think, 40 to 50 sort of structures within their corporate group. You don't want to be setting up structures for no reason, because it does add unnecessary complexity in some cases. But, it is always really good to weigh up not only the tax, but future proofing and asset risk as well. So it may be okay. I'd recommend with that, talk to your advisor and just make sure that they're able to explain to you why they're setting it up. And look, it should be fairly logical, so it should be easy to sort of grasp. But look, that's all we've got time for today. We're running a couple of minutes over the 45 minutes that we were going to say. But thank you so much for your time and attention. If you are wanting some personal advice regarding your structure, feel free to contact us at optimizedaccounting.com.au, and we can book in a structuring meeting with either myself or one of our accountants. Have a fantastic day.